Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. I am so fortunate to be able to spend yet another hour with, or maybe less, with my good friend Eddie Blanco from Miami. Eddie, how are you, pal?
I'm doing well. It's great to be here, Bill. Thanks for having me.
Eddie is the broker of Stratwell Real Estate. He's been a REO broker for decades. An REO broker, for those that may be new to the world of real estate, is real estate stands for real estate owned, and it's mostly for those of us that lend on real estate, corporate lenders, banks, pension funds, any kind of private equity groups that own real estate. They often refer to it as REO. Even corporations, like restaurants, have REO divisions. That's the real estate that they own. And so he specializes in that. So you'll hear us refer to that a lot. And that's really being in the business of dealing with a lot of foreclosed properties and whatnot. And but even more than that, you've taken on a public role in Miami, Florida, of all places, as the chairman of the Miami Association of Realtors. Eddie, say what more can you say about yourself?
I think you covered it well. I love what I do. In addition to the stuff that we've done as far as REO, is we've taken that, we've expanded that into helping clients in the SFR, single family rental space, right? So corporate clients who want to acquire a property, put them in a rental pool. We did a lot of that 2012 through about 2017, 2018, when Miami no longer made sense from a institutional acquisitions investment space. And it was also taking that systemized approach, strategy, and applied it to traditional sellers. So we work with a lot of homes, regular home sellers. About a third of my business is working with the traditional home sellers or small investors who want help on how do we maximize the home value by making some repairs or strategy on pricing, or maybe other strategy that we could bring into the picture. So we do all of that.
What's amazing is and you're a true Miami man, right? I want to really get a conversation going about the world of Florida right now. I grew up in Florida, started in real estate in Fort Lauderdale, Florida, just one county north of where you are. It's now a county that you work for us and you're very familiar with.
Sure.
A lot has changed since you and I grew up in the 70s and 80s,
Yes, sir.
And we don't want to date ourselves too much, but there's a lot of history to it,
Yeah. Miami was, everybody knows the history of Miami in the 80s. It was a place where people came to party. And then South Beach was just a bunch of retired people, older retired people. It was a sleepy town. And there wasn't a whole lot going on. It wasn't the hot and sexy thing that it is today. Now Miami has become a true international metro. And when we say Miami, I say Miami, I'm talking about Miami, but I'm also talking about the MSA, the Miami MSA, which includes Fort Lauderdale and Palm Beach County.
The
the three
Tri-County
counties on the
area.
southeast. Yeah, and because people from all over the world they call it Miami, but in the end of the day, it's any one of those markets that they're really.
Correct. Correct. Yeah, the Miamians have no problem taking credit for Palm Beach and Broward.
Right.
but a lot of there's I'll tell you there's some snobs up there in Palm Beach who say, "Oh, I don't do Miami."
Nothing to do with Miami, that's for sure. Yeah, and I would say there might be some sentiment the other way around too. So
That's
I mean,
true. That's true.
they're totally different markets. They're very different demographically, economically, lifestyle wise. They have a lot of different things to offer. They're all cool and diverse in their own way, and they're different markets. Palm Beach County has just gone gangbusters in terms of attracting incredible wealth. It's unbelievable.
There was an article in Wall Street Journal the other day that pointed to the fact between Palm Beach and Miami itself, downtown Miami, they really call that whole area, they're really calling Wall Street South, right? And back on the on the point of Miami and Wall Street South, that downtown market, that luxury market. I mean, I can't believe that things are still trading. I popped into a private VIP report you were doing the other day about the condo market, and we'll get into that a little bit more in depth in a minute. But one of the most astounding things was the tale of two cities within a city that exists in the market right now. And it really, in a demographic point of view, the A-plus properties, downtown Miami, new construction or even retrades of stuff that's built in the last 15 years, the newer stuff that you were showing still advancing in price and not really over flooding in terms of volume versus the market, the rest of
the market,
the condo market.
The complete bifurcation, right?
Yeah.
This, we've had this incredible wealth migration that's come with talent migration. Is a different set of people who are moving here. A lot of businesses have moved here, and they brought a lot of investment into the South Florida market, and as a result of that, brought in higher skilled, higher cost labor. Those people want nicer restaurants to go to. That brings in more investment. That brings in higher paying jobs. It just has a perfect storm on the upside, right? Like some growth opportunities that Miami's experienced. And a lot to do with our governor, a lot to do with our mayor, who have been, pushing for, we were like, for some time during pandemic, people thought Florida was crazy for being still open in some ways. And in many ways, it came out to be
it paid off, baby.
Everybody brought their money here.
It paid off in a big way, really.
It paid off in a big way. Yeah. Yeah. I mean, so not to get political or anything, but I'm just saying that, that choice, do we weather the storm and keep everything shut, or do you just let people open their businesses if they want to? That freedom of choice led to an economic growth that was extraordinary.
Weathering the storm is a great analogy. It's a good segue into, what I think is maybe a headwind for the future of Florida. We haven't seen a major storm impact the southern part of the peninsula the way it did when you and I think I was a junior in high school when Hurricane Andrew hit. You might have been in grade school. You're younger, right?
Middle school. Yeah. No, just a couple of years.
And we haven't seen anything major like that hit the city. We have already seen a huge increase in insurance costs across the board. That's another thing that impacts the condo thing. We'll come back to that in a second on the condo still. But the insurance is a real problem. Friends of mine in commercial are getting out of Florida because they can't get insurance, or they're choosing to self-insure. Where do you see that? What do what's the talk there in your world?
I'll say this, I've been involved in a lot of the talks with some of the legislators. I mean, regarding it, there was a tort reform that took place about almost 3 years now. What was happening, really, the issue with Florida is two things. Yes, we get hit by hurricanes, but there's natural disasters
Right.
all over the country, right? What's different about Florida is South Florida, and the amount of lit, legal battles that take place over some sketchy claims that are made by South Floridians. That's just the reality of it. There's a rampant amount of fraud. And I mean, you
Really?
maybe you don't want to call it fraud, but let's say you have attorneys who are very aggressive in terms of the claims that they put, and the tort reform is making it such has made it such that it's more appealing now for insurers to insure in Florida because they're more protected. Before, if you made a claim against the insurance company and you were just up by $1, the insurance company was now liable for all of your expenses. Here,
Uh,
so now there's some tort reform, and I'm not keen on exactly the details of it, but it has led to um, insurance companies feeling more safe coming into the Florida market, and the reinsurers, which is where the challenge has been, opening up. So last year was the first year that insurance rates didn't increase, and we didn't lose any insurance companies. So that
hmm.
was positive. So the year before it was really bad, and the year before that even worse. So that concern has settled a bit. It's still an issue when it comes to affordability, but at least we're not increasing at the rates that we were before, creating more problem, right? So yeah, but insurance is still an issue. But I know that aren't you writing a book on this
I
whole topic?
am. I am. I was
Really?
hoping you were going to give me some content here. I'm on draft two. Uh,
Yeah.
I've got some people helping me like with the editing and the rewriting, and I'm looking for a little bit more. Give me something to print.
Yeah. Yeah. No, I think this is an issue that the United States is facing. Insurance, the cost to rebuild has gone up. Uh, and these insurance companies need to figure out how they're going to address. How do you protect against these wildfires? I mean, come in L.A.
Right.
That what happened in California.
Well,
I mean,
it'll be interesting to see. I mean, I think that the one of the great messages of the last year, or a year ago, I started to write this book, The Storm. That's the tentative title. It may be end up being called something else, but it's really about how financial markets will meet Mother Nature, and you know, whatever you call it, we are in a period of climate volatility right now. Okay. However it was created, man made, cyclical, the proof is in the pudding. The insurance rates are going up across the board. There are areas of this country that are seeing massive devastation that would never have expected to see something like that. Flooding, the Asheville, Carolinas, having a hurricane impact. We saw that up the eastern seaboard. What we see in California with the wildfires, and that's just
the
gonna
Hawaii fires.
Hawaii exactly, and that's just gonna continue. I mean, it's like that's every year this stuff comes
Yeah,
when
yeah.
you start to, well, I can't believe how we're happen to be 1 in 500 year events. That's a 100 year event. We're hearing 100 year events are like every month. 500 year events are every quarter, and 1,000 year events we're getting about once every year right now. Do
It's
you
something
think
else.
that we need to change the scope, or at least acknowledge that climate volatility and climate instability exists? And that's something that's going to cost us. It's going to impact directly the cost of real estate, because real estate at the end of the day is just a measure of what folks can pay versus what it costs us as landlords to charge them. and what's that worth? So if I'm getting less money, if we're getting less NOI owning property because our costs are up, then the value of that property, if I try to resell it to another investor, is obviously lower.
Right.
I mean, it's basic 101. So where's your
Well,
not to
there's
lead
another
the
impact of that is that when that NOI is lower, then it creates little or no desire to create new buildings,
right,
new construction, which
right.
in one way helps to stabilize pricing, in one way, and so
We
you want
do
to
need
continue
to
you want to
see.
continue to see circulation of the economy of money. You want to see a higher and better use of land constantly moving. Otherwise, you get problems, blight, or the other way around, where you get just prices get really, really constrained.
You have a couple of condo projects in downtown Miami that are stalled, some luxury, nice buildings. And I'd hate to see the market get that bad that they can't get a project like that off the ground, or even, the affordable condos. But you happen to have been like sounding a few alarm bells the other day in this talk you gave
Yeah.
about condos. Why don't you
Right.
sum it up for those that don't know what's going on in Florida, even in this amazing part of Florida, the Southeast Florida?
The reality is that we had I think all your listeners have to have heard of the Champlain Towers that collapsed in Surfside and killed 98 people.
Right.
That the end game is the result of that was simply one thing. The association, well, it's a combination of things, but primarily the association failing to collect enough money in reserves to make the adequate repairs that were necessary, that they knew were necessary, that they had been warned about by engineering reports years prior. So it was a lack of transparency that the people that were living in there weren't fully aware of it, a lot of them, and a lack of willingness to spend the money to improve that property. You have a house, I have a house. I know that 20-year-old roof is going to last me another 5. And I'm going to have a, tens of thousands of dollars ready to replace that roof. That's reserves. The state of Florida allowed for a very long time for associations to waive that requirement to hold reserves. So all of a sudden, Surfside happens and they pass all this legislation, rushing the process. Now you have to get inspections. Now you have to do structural integrity reserve studies. You got to figure out what your building needs, how quickly it's going to need it, and how much money you need now and into the future to make those repairs. So now homeowners, condo unit owners are getting hit with assessments, some very small, 5, 10, 15,000, a lot in the 20, 30,000, 40,000 range. I've heard assessments as high as a couple $100,000. Could you imagine? One day you have no bill. The next day you have an extra $50,000 bill. And you're 68 years old living in a 55 plus community and you're on a fixed income. Where are you going to get $30,000 from? So these people
That's
are now
right.
in a financial situation that is not pretty. And so that's causing an economic supply demand problem. And you know what happens when supply and demand become unbalanced? In this case, the prices are going down. But it's not across the board. We talked about
Right.
the segmentation of the market, and it's not doomsday for all condos
Oh, of course.
all over Florida, right? It's
Right.
not that.
Yeah. It's just doomsday for most condos.
The ones that are 55, I would say that if it's a 55 plus community and it's an older building,
Well,
it's not
think
pretty.
about this. Think about this, and I want you to give me think about the numbers. I'm going to ask in a second, but realize what you're saying. When a condo association, you own a condo free and clear. You owe the dues just to stay there to keep the common area. But other than that, you own a condo free and clear. Most of associations have and must carry the right to give a special assessment to do maintenance on the building.
Yes.
Now, you get hit with something, whether it's 10, 20, 30, or 40,000, like you're saying, that's still a lot of money if you have no money or you're not on a fixed income. But imagine if it's 100,000. Either way, this is like an obligation you have to the other homeowners that you own a piece of that building with.
Yeah,
The debt. It's a
they can
full.
foreclose on you. Yeah,
Yeah.
they can take the property through foreclosure.
Wow.
They have the lienable right and foreclosing right. So yeah,
So I mean, like a special assessment is basically like a pop from nowhere debt that is falling upon the laps of thousands. I mean, how many condos are there in the
there's
in
6,000 in Dade and Broward County.
wow,
6,000.
just
That's
in
all.
Dayton-Broward County. So
Yeah.
6,000 condos. Now, obviously, not all of them, like you said, are affected by it. A lot of the luxury condos are newer.
Right.
They have reserves,
Right.
but would have to assume a good more than half of the condos out there at least have some sort of special assessment in their future. Correct me if I'm wrong.
I mean, I would say that I don't know what the percentage would be, but yeah, there's going to be a higher number of people the buildings that have foregone some amount of repairs. And let's put it this way: every condo that I've been dealing with recently, especially the ones that have gone into mortgage foreclosure and end up in REO, all of them have assessments. So yeah, that's 100%. So but I guess it's going to depend. But I will say that the problem exacerbates by this. When there is an inspection report on file, well, Fannie Mae, another thing that happened during that collapse of the building, Fannie Mae, before the state made any changes, Fannie Mae put out a new questionnaire, condo questionnaire, and it asked them about asked them structural questions. So this has gotten even more interesting because now in that condo questionnaire, the associations are now providing, hey, here's the inspection report. Here are the inspection findings. And Fannie and Freddie of the worlds, and I'm talking all the investors that buy these loans, but particularly these two that are the biggest, are saying, hey, we're not going to lend in a building that has a roof that needs to be replaced in a year or now, and elevators that need to be replaced now, or even if they're in construction. So now lending becomes not an option. And that eliminates most of the buyers in the marketplace, especially for that lower price threshold. It's ironically the multi-million dollar buildings, those guys have cash.
Right.
The guys, the $400,000, $500,000 buildings, those depend a lot on financing. It's a lot fewer cash buyers in that marketplace.
Right.
Right.
And then, just to reiterate it, I mean, you could see the entire mortgage market for a plethora of these condo buildings disappear because of this whole situation that's building up.
It could be interesting to see. I thought, it'd be interesting. I thought it would have been cool if, some of these large servicers, large mortgage investors would have reached out to their borrowers or created some type of special program, right? Where hey, look, we have the first mortgage on your property. We know you just got hit with an assessment of X dollars. We're going to give you some relief. We're going to pay that assessment, and then you can add that payment to the mortgage because the lender's already at risk, right? The lender's already at risk in that loan. To add a little bit more risk to avoid the whole entire building not being stabilized, there's some interesting play there. I mean, I'm not a Wall Street numbers guy, but it doesn't look pretty, and some solution would have been better than what's taking place right now. It's not pretty, and the legislators know the risk. A lot of them, I think, have underestimated how bad it could get. There's other market factors that are affecting Florida as well. That if the market was still humming and we had this condo problem, maybe it wouldn't be a big deal. But the market's kind of not. And we have this condo problem. That's not good. But the legislators said this simply, like the economic impact is not as concerning to them as the loss of another life as a result of a building collapsing under their watch. So that's their position.
Well, I guess, better safe than sorry. I mean, even if it does cause an entire condo market across the state, if it's 6,000 in Dade and Broward County, then one has to assume that you've got tens of thousands across the state of Florida.
Yeah.
Well, that's exciting stuff. Whenever the shit hits the fan, that also means it breeds opportunity. As
Sure.
you and I have talked about, let's put together a strategy to go find just the right product, because Florida is cyclical. It's always been cyclical. What goes up in life must go down. We've been screaming that at the rafters. The stock market still hadn't figured it out. We thought it had for a moment, but I'll tell you, 60% of American residential counties have already figured it out. Residential real estate has finally turned in a lot of markets. The top has been seen. Everyone realizes interest rates are not going down again, or at least not significantly in the near term. I can never let anyone go without predicting the future, Eddie. What we've talked about this before.
Yeah.
Reprise for me what your prediction for the next 12 to 18 months is.
I want to say something about that. I want to tell you my prediction, but I want to say that we've heard a lot of jargon and people like to repeat the same thing over and over again. This story about inventory automatically becoming this extinct product, right? Remember, prices were going up because inventory was going away. There was no more inventory, and that was causing prices to go up. Well, prior to COVID, we had the same amount of inventory to a year later after COVID. Why all of a sudden is this all crazy? And by the way, prior to COVID, the market was already starting to get kind of funky, right?
Right.
When COVID happens, the government injects billions of dollars into your economy and prices start going up. And the reason people say prices are going up is because inventory has gone down. And what I say is no, demand has gone up because people have way more money than they need right now. And they're injecting it into real estate and all kinds of asset classes. So the tide wave is pulling back. Now, to answer your question, I think that tide wave is going to pull back and continue to recede. And you're already seeing it. Americans are now they have those the piggy banks are big because they have a lot of equity in their homes, but that equity is starting to dwindle. And you know those Americans are doing? They're going and getting car loans, and they're getting credit card debt, and that school loans are stacking up, and
HELOC.
So those HELOCs. Oh yeah, and so that gap is shrinking, and it's happening quickly. And all it takes is a little bit of something to give, and it's not going to be in real estate. I don't believe it, like it happened in 08, the Great Recession. But something has to give. I was talking to an agent who's been in the business 12 years and said, I've never seen it this bad. I said, well, you've never seen it bad. You've never seen bad at all. You've seen a increasing market and a supply-demand imbalance from 2012 all the way up to 2024. So
that's right.
12 years of glory and easiness in business. I mean, and there was peaks and valleys in that, right? But it was all up.
That's right.
So
if you're a 32-year-old banker today, and a lot of the bankers out there are, you would have been in grade school when the great financial crisis hit. And you certainly have never, until a few years ago, never dealt in a situation where money cost you anything. And my father used to say, and he actually passed away in 2007, a year before the GFC crash. He used to say, anyone can make money in an up real estate market, kid. What separates the men from the boys, the girls from the women is tough times and being able to work through those times and deal with people with dignity, which, by the way, I always acknowledge you for the work that you guys do. Is quite a great operation. Okay, so back to the prediction of the next 12 to 18 months.
Yeah, I mean, the next 12 to 18 months, I expect, the cracks to widen. I can't imagine things, hobbling along. That's a possibility, but I just have a feeling that there's going to be something that goes and just has a little bit more of a slide than people expect. There's some misnomers in the business, right? That you can't ever lose in real estate. That's funny. And
I've definitely done. I think I definitely did an episode or a podcast, not here, maybe Real Estate Lowdown or a webinar about about the fallacies
Yeah,
of,
misnomers. Yeah,
yeah,
fallacies. Yeah,
exactly.
real estate. Oh, real estate always goes up. Well, I
Yeah,
mean, if you look at it over 30 years, but if you bought it in the in the wrong time, tell that to the people who bought in 2007. That real estate doesn't go down.
that's right.
Yeah, 2 years later, they were looking at 25% of what they 60-70% loss. I mean, unbelievable.
Yep.
I don't know that we're going to have another catastrophe like we'd had on our hands, but this, like, think about this also. Those cohorts, FHA, that cohort that bought in 2022, 2023, they're in double digit defaults. You know, that whole we had COVID, that was another opportunity, right? It was not only there were people who weren't paying their mortgage because of COVID, and people weren't paying their mortgage because of other reasons, right? You have divorce, you have death, you have loss of jobs for other reasons, and hospitalizations, all kinds of reasons why people go into default, and all of those were temporarily just held off.
Mm-hmm.
That market has to come back, so we've seen very low inventory numbers in REO, below average numbers, and those numbers are starting to come back up really quickly, and I think they're going to surpass that low average and go up into, in some markets it's going to get a little ugly.
Another misnomer, as I'm sitting here thinking about it, is this whole idea that we're this lack of supply that
I don't
exists in housing.
I don't buy it.
If you do the math, we have more per capita housing out there that exists than than we had in 2008. And in 2008, there was a lot of vacant housing out there. So the minute that the market turns, people have their second homes, people have their Airbnbs, these private equity firms go bust that are highly leveraged on these rental portfolios.
Sure.
Something has got to give, but you're right, it's not going to be real estate driven or mortgage driven in that sense. There could so many other asset classes and so many secondaries and so many derivatives and bond markets and things like that could have some kind of black swan that would then cause us to have some fun as well.
Yeah, it's going to be interesting for sure.
Get your popcorn ready, right?
Yeah, that's what I'd say. Yeah, get your popcorn ready, because I think it's going to be there's going to be some opportunity for sure, for people who are in the space of wanting to invest in real estate. I've got some plenty of clients ready to on the sidelines waiting. I've the amount of people on the sidelines waiting has dwindled. I will tell you that there's a lot of people who already have run out of money.
Right.
That's what I'm saying. The wave of cash that came into the U.S. is receding. I see that, and it's going to be a time where people are going to have to sell that second home, or that kid's going to have to move back home with mom and dad, or they're going to have to get rid of that Airbnb that they thought they were real estate gurus, and now they realize that real estate isn't. It's not
that easy.
Not a passive investment. It's a very active investment. You got to really understand what you're doing in the real estate space to be successful long term. So,
yeah, I know we've talked about that over lunch, and at the end of the day, it's got to pencil. It's got to make sense. If it makes sense, you'll never go broke. You'll never lose money. But so what happens often in the residential markets is people play the appreciation game. They play it like it's a stock market. It's it's like they don't like it's something passive. I'll own it and see, and hopefully.
I heard a guy on a YouTube channel talking about negative cash flow, and like that's a way to invest. You create. I mean, you negative cash flow, but it doesn't matter because you get tax benefits and appreciation. I'm like, well, why would you buy a negative cash flow real estate when you could buy positive cash flow real estate that you can also write taxes and it appreciates? But yeah, that is where the mindset of some people have gone, because they think that it's just never going to come down again. It'll just keep going up forever and ever and ever. And it doesn't happen that way.
And it does.
There'll be people in trouble. There always will be. And I'll say there's a lot of investors who have been saved by an upswinging market. They've been saved. They bought wrong. They bought wrong. They over improved, but they just got lucky that the market just kept going. But now the market stopped going, and now it's flat. So now if you made a mistake 8 months ago buying a house, you're going to pay for that when you go to sell it today.
Yeah. Oh, yeah. And listen, I can see them. Every day I'm hearing a new person, whether it's a personal story of someone who overextended themselves and never was able to catch up, whether it's a change of interest rates that's really caused someone to be in trouble, whether it's a real estate deal from 3 years ago that, the minute rates changed, the value changed, they saw it through, they're upside down. On the commercial side, we're seeing it left and right. It's just there is unfortunately a reckoning to be had, and I don't know. It's you know,
Take a drive through Lehigh, get a preview of what's going to happen, or maybe across the whole state. Because
that's
Lehigh,
so right.
every other house has a for sale sign, and the price reductions they've been going on for 18 months. They just they can't chase the market down fast enough.
Does that remind you of Port St. Lucie or what?
Yep.
That was like
Although
us.
Port
That's
St.
when
Lucie now has established,
it has maturity now. Yeah.
Matured. Yeah. It has the maturity. Yeah.
But that was what it was like when I got started, buying with Condor back in '08. The first portfolio we did was the construction to perm loans in Port St. Lucie, and those things were vacant. It was a scene out of The Big Short.
You were picking them up for what?
20, 30 grand a door, and there was 28 cents on the loan. You're probably about 50 grand a door, and you were building them for 200 grand, so let's hope it doesn't get that bad.
No, I hope it doesn't get that bad. That wouldn't be good for anybody, really. But
that's right.
But yeah, so I wanted to say that I wanted to say that I just valued and appreciate the way you've run your business all these years, and our friendship that we've established over the years. It all started from your book, and when I read that book, and I was like, wow, this is a guy who is in a position that really doesn't have to bend over backwards to help people out. And you were doing that. And you wrote about it in the book, many stories, very cool stories, really fun book to read. And it really speaks to the compassion that you can have in big business, making lots of money and doing right by people. And those things can all be in the same bucket. And you got that. And that's awesome.
Well, I appreciate that acknowledgement, Eddie. It certainly is a trademark and what we strive to do. It's hard to believe that someone can make collecting mortgage loan debt and going after properties Dean lose into a fun and entertaining story. Now, that is pretty, actually, now that I look back on it, it's a pretty big feat.
Yeah.
But and the next one will be a different. Well, it'll definitely have some of my humor, hopefully, in it. But it's also another story about storm clouds. So
yeah.
And you, by the way, are a leader in South Florida, and I do acknowledge you. When we first met, it was because of the book, and you gave a donation to a cause that we were both supported, St. Jude's. That we went to lunch after that, and I just was, we just really kind of always appreciate, your approach to the business and what you've done, and well, we're going to be talking more, I guess.
Yeah, we will be.
We'll be back and talking to you after hurricane season.
Yeah, let's hope we dodge that one.
In the meantime, new HUD trade, get to work, my friend. Let's not publicize too many competition, but it's been great hanging with you. Thanks for joining the Debt Doctor.
All right. Pleasure to be here. Thank you, Bill.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.